Good morning. Welcome to 3 Minutes of Markets and Money. I'm your host, Lance Roberts. Well, it's been buy the dip for the last couple of days. Not surprising here after coming down and actually hitting right on the 50-day moving average. This has really kind of been the action of the markets since last November. This 50-day moving average has continued to be very critical support for markets going all the way back here. And again, a very unusual kind of activity in the markets where the 50 and the 200-day moving average are running exactly in parallel with each other. This is kind of a very unusual trend of the market, this very kind of complacent rise in prices. And this is simply just a function of what's going on with QE. Of course, $120 billion a month. We've trained investors that as long as there's QE coming into the markets, you buy the dip, and that's continued to be the process here. The one thing about this, though, is that, again, as we've been discussing here over the last couple of months in particular, it's been a very long time since we've had a 5% correction or more in the markets, and that risk still is prevalent, particularly as we get into August and September. So again, a bit bigger of a correction here at some point is not going to be surprising at all, and just something that you should at least be somewhat prepared for. It doesn't mean that you should be all in cash and waiting for the dip. That's not what I'm saying at all, but you can do a few things to kind of hedge against that potential risk. Yesterday, as an example, we added some longer duration bonds to our portfolio as well, just potentially to hedge off on that risk of a deeper decline, because as we saw during this decline, Friday and Monday of this week, we actually saw bonds produce very well in terms of adding that risk management to the portfolio. Markets are doing just fine here. We're continuing to still work through our sell signal. And again, that is not surprising here that markets are just kind of consolidating sideways here as we kind of go through this sell process. We saw this previously back on this sell signal as well. And again, back over here as well. So these consolidation periods during these sell signals are absolutely normal. Simply nothing to worry about. Now, the one thing to at least be aware of at this point is that we did have a very large spike in volume on the sell-off on Monday. This rally over the last couple of days has had a very sharp decline in underlying volume. So this hasn't really been a strong participatory rally in the markets. This has simply been a very light impact of money flows coming into markets. But again, this is a function of that kind of lack of liquidity in the overall market. It doesn't take a lot to move prices higher here. And again, that money was concentrated primarily in a lot of those FANG stocks. Now, we did see a little bit of that broadening out of the rally yesterday. We saw energy get a nice bounce yesterday. Financials picked up a little bit of a bounce with the decline in rates. So we did see a bit of a pickup there as well, and a little bit of a broadening of that. But still, when we take a look at the overall market, the number of stocks trading below their 50-day moving average is still something of concern. The breadth of the market continues to remain very weak here. So while there's nothing wrong with the markets at this juncture, again, as we move into August and September, there's still the risk of a bit bigger correction because of simply just the length of time that we've had. And again, it doesn't mean that it has to happen. It's just something that you need to be at least aware of and maybe have a little bit of protection set up in your portfolio just in case something like that does happen. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you tomorrow.